If I paid attention to my super at 20, I'll be $50,000 better off today. That mistake still stings. And if you ever thought,
I'll deal with my super later,
this might be the most expensive habit you'll ever have. I'm Davie Mack, a chartered accountant, and I've helped hundreds of business owners use SMSFs to lower their tax bill, protect assets, and grow long-term wealth. In this video, I'll walk through exactly how self-managed super funds work, including the structure, the tax advantages, and how I personally plan to transfer my own commercial property that I own into a SMSF. Let's get into it. So you're a business owner or a professional in Australia. You're probably paying somewhere between 25 to 47% on your income. And for a long time, I did the same. I focused on growing my business and structuring my company, but completely ignoring my super. So for young Davie back in the day, Davie used to think that super was just for retirement. And I didn't really need to think too much about it. Whereas older Davie, well, not that much older, but older Davie, started thinking that super can actually be used for many things. One is for investments, another for leverage, and the last thing that you can always do, and most important, is to minimize tax. And that's the power of using a self-managed super fund. So let's break down how to use it. A self-managed super fund, or SMSF, is essentially a trust that exists solely to manage your retirement savings. The members can be chosen by you, but most likely it will be either yourself, your spouse, or family members. And then what would happen is that you would also have a trustee. And usually a trustee is the person or the company that controls the SMSF assets in the trust. However, the trustee company will need to ensure that the members are the directors. So make sure to get that right. What would happen then is we've got the SMSF that controls the assets for your retirement, and the members can then decide on what to invest in. They have control of the investments, the decisions to be made. Obviously need to abide by the superannuation laws, but the investments you can have are with residential property, commercial property, dividends, shares, ETFs, even crypto, if you know what you're doing. The great thing about SMSF is it's taxed at 15%. We have a general 15% tax rule, which is a lot more lower than the individual and company tax rates. And if you've sold a property or an asset that you've held for more than 12 months, you actually can lower that tax rate to 10% for CGT purposes. So those assets that you're selling could be, residential property or commercial property, or even shares, ETFs, or crypto that you've held for more than 12 months. So technically, you can get the 15%, even lower to 10%, depending if you've held the asset for more than 12 months. The 15% tax rate is actually for the passive income that the SMSF earns. So for example, dividends will be taxed at 15%, and possibly the rental income that you're earning from the commercial properties as well as residential properties will be taxed at 15%. So as you can see that the tax rate for SMSF can be 10% to 15%, which is far more lower than the 47% tax rate that most individuals will have to pay, especially when they're earning high income. And if you've been building up retained profits in your trading company, or you're already earning good money, this is where it gets powerful. So in your company, you could be paying 25% in taxes, and in your personal name, you could be ranging from 39 to 47% in income taxes, including your Medicare levy. The great thing is that SMSF is anywhere between 10 to 15%. This is actually essentially the lowest tax rate you can get in this country. So if you're reinvesting profits or holding cash in your company, the question becomes, why not route that into your SMSF? And yes, I get it. You can't access that money until you retire, when you're 60. But ask yourself, are you really going to spend every dollar that you earn today? Or would it make more sense to grow it inside a structure designed to protect it for long-term growth? Because for a lot of my clients and for myself, SMSFs aren't just a later game. They're part of the now strategy. Part of that strategy is also thinking about how you can leverage your SMSF to make investments. When most people think about super, they assume it's just about putting money in and waiting for it to grow slowly. But with an SMSF, you can actually borrow money inside your fund to buy assets, especially something like commercial property. So if you've reached a serviceability ceiling in your personal name, you could consider investing with your SMSF. Let me give you an example. Let's say you and your partner are both contributing to your super and you manage to come up with a SMSF cash balance of $300,000. And with super funds, you can actually borrow up to 70% LVR, which means that you can put in $300K as a deposit and then borrow the $700K for a total value of the property to be at $1 million. So technically, you're not investing $300K, you're investing $1 million. Let's just say that over 2 to 3 years, your property value goes up. And it goes up by, let's just say about 10%. That's potentially $100K potential return on the value of that property. So then your total balance now is $400,000 after the potential return. So in the last 2 to 3 years, you've been able to increase your balance by 33%, from $300K all the way to $400K just by using the power of leverage. So for that $100,000 profit that you made, that could be taxed at 30 to 45% outside of your superannuation fund. In your SMSF, it's just taxed at 15% or 10% if you've held the asset for more than 12 months. So the benefit is twofold: leverage and reduced tax. Like anything though, you don't want to overdo it. I've seen many clients borrow 80% for an SMSF property only to run into negative cash flow and then be stuck with all the red tape that comes with running an SMSF, while also having a negatively geared asset in an SMSF, which is a no-go for you. The key is to borrow conservatively and make sure the SMSF has enough cash to cover costs, audits, and loan repayments. Now let me show you how I'm personally planning to use this strategy. Right now, the office I work in is owned by a unit trust. It is not part of my SMSF, but it will be. So here's the plan. Once my super balance reaches the right level, I'll set up an SMSF. I'll go to the banks, try to borrow as much as I can to buy my commercial property off my unit trust for the market value. And as a result, my commercial property will move over here and my unit trust will get a certain amount of money for the sale of the commercial property. That would mean that my unit trust would then have equity for me to reinvest into another asset or another investment that can bring in more returns for myself. On top of that, my accounting business will also still need to pay rent. So initially I was paying rent to my unit trust, which was then getting taxed at 47% in my personal name or in my company at 25-30%. And now the accounting business is going to be paying rent. And that rent would then go to the SMSF. And that SMSF will be taxed at 15%. When I retire, the SMSF enters pension mode. At that point of time, the same rental income that I receive from my company could be taxed at 0%. I only plan on doing this when my super balance reaches the right level. And funny thing is that situation is right now. An SMSF is powerful, but it's not the right move for everyone. And I've seen people jump in it way too early. Then it backfires. If your super balance is under $200,000, the ongoing fees alone might eat up all your returns. And if you're not confident of managing your own investments or keeping up with compliance, it can become very overwhelming quite quickly. You have setup costs, audit fees, annual admin, and if you're borrowing, a whole extra layer of structures with things like bare trusts. Let me show you a quick comparison of costs. Industry super funds usually charge a percentage of your balance, often between 1 to 1.5% per year. That means if you have a balance of $300,000, you might be paying over $4,000 every single year, and you're still limited in terms of control, leverage, and flexibility. Within an SMSF, the costs are mostly fixed, so the break-even point is usually around $250,000 to $300,000 mark. If you had that in your industry fund that charges, let's say, 1.3% in annual management fees, that works out to be just under $4,000. If you compare that to SMSF with a fixed fee of around $2,500 for admin compliance and accounting, and then another, say, $1,000 for the audit, your fees are lower using an SMSF. As you can see, at around the $300,000 mark, your annual SMSF cost is lower than what you would pay in an industry fund. And the more your balance grows, and the more you combine it with your family members, the more cost effective an SMSF becomes because your fees stay relatively fixed while industry fund fees continue to rise as a percentage of your balances. So here's my honest take. Quick disclaimer, I'm not a financial planner, so seek professional advice for your situation. But here's what I would do. If you're not planning to buy property, if your balance is too small in your SMSF or your super fund, or if you do not have the time or team to support you, stick with an industry fund for now. But if you're sitting on retained profits, thinking about long-term wealth, and want more control over your investments, then this is worth exploring. See you guys later.